When you hear the words retirement annuity, what images are conjured up? Do you think it's an old school investment product with excessive fees, that it doesn't really return any kind of returns to you or performs very well, that it's very difficult to structure, and that it doesn't really provide any value to your total portfolio? In this week's episode, I'll delve into the good, the bad, and the ugly of retirement annuities with a specific focus in terms of how you can use a retirement annuity to dramatically and save massive amounts of tax. You do not want to miss this episode. Let's get stuck in. Hi, welcome to this week's episode of the Financial Dispensary with me, Dr. G. In this week's episode, we're going to focus on the retirement annuities. What are they? How do they work? What to look out for? And very importantly, how to structure them to save massive amounts of tax. So first, very importantly, we need to have a groundwork in terms of a retirement annuity and the good and the bad and the ugly. So in a nutshell, when you save towards retirement, there are three major vehicles that are currently available in South Africa: traditional pension funds, provident funds, and then also retirement annuities. So remember, a pension or a provident fund, effectively, there needs to be an employee-employer relationship. So you effectively need to work for a company. You are then a member of the company's pension or provident fund. Now, for anybody that's unemployed, obviously there was no employee-employer kind of relationship. I work for myself, so how can I create my own pension or provident fund? And that was specifically the reason why a retirement annuity was structured. So in theory, the idea was that a pension, a provident fund, and a retirement annuity should be exactly the same. And the government, from a legislation point of view, is actually going through a process over multiple years already, calling it a harmonization of all three. So sometimes you'll see that on a benefit statement, they'll use the term pension, provident, or retirement annuity fund, but they might also kind of change that to just a retirement fund. Because in theory, the way that I see it, the way that it should actually be, you should just have a retirement fund, and there might be slightly different rules depending on whether it's a pension, provident fund, or retirement annuity. For today's episode, we're going to focus into retirement annuities. It's very common, it's very well known, multiple providers provided, and we're going to go through why you want to utilize a retirement annuity in your tax planning. So first, very importantly, let's just get the structure right. There's two broad brush kind of groups of retirement annuities that you can get. One that we call kind of a life annuity, and one that's a unit trust based retirement annuity. So when I say a life annuity, a life retirement annuity, think about any life insurance company. So if you see the logo of any life insurance company on your retirement annuity statement, it is 99.9% of the time a life annuity. So the big names, the Old Mutual, Sanlam, Liberty, Momentum, Discovery, etc., most likely it is a life annuity. Where the alternative is what we call a unit trust annuity. These are a unit trust retirement annuity, very importantly. These are the likes of Allan Gray retirement annuity, a 91 retirement annuity, a Stanlip retirement annuity, a Glacier retirement annuity, and so on and so forth. So very importantly, it's very important that you understand that there's a difference between the two, and it's all got to do with the second point, which is fees. So retirement annuities have got a very bad rap that it is an excessively expensive investment vehicle, and I must say I do agree with that, specifically the life retirement annuities. And the reason just for that is that the commission, the sales commission that's built into that financial product is lumped right in the beginning of the product. So remember, when you save for retirement, it's obviously a long-term investment that you're trying to save towards. But because of a life retirement annuity, all of that upfront commission is added to the starting point of the investment. And in a nutshell, what it effectively means is that in the initial couple of years of a life retirement annuity, it is very expensive. So even the market needs to effectively shoot the lights out for you to have a solid kind of return. So because of that, it's very important that you rather opt for a unit trust retirement annuity. And it all boils down to this kind of point that if you look at the underlying structure in terms of how the fees are structured, this is outside the scope of this video, but you need to zoom into this effective annual cost, and you'll see that roughly the effective annual cost of a unit trust retirement annuity on average is much less than a life retirement annuity. So that's a second very important part. Choose a unit trust retirement annuity for this specific reason that we know the fees are less. Third important point is in terms of the portfolio. So remember, a lot of clients get confused. So you receive your statement in the mail and it says Allan Gray retirement annuity. And then you think Allan Gray manages your retirement annuity. That's not correct. Allan Gray is purely the administrator of your retirement annuity. You need to look in terms of who the underlying portfolio managers are. These are the people that effectively manage the funds that are in your Allan Gray retirement annuity. So these are like of all the big asset managers, the names that you can know. Again, it could be potentially the Allan Gray, 91, Coronation, Prescient, etc., Foot, Fairtree, so on and so forth. So it's very important that you understand that there's a differentiation between who the administrator is of your retirement annuity and who the underlying portfolio managers are. So make sure that you know who the portfolio managers are. We want to know who are they and how much do they charge for the investment management services that they offer. All of these tie into the fourth point, which in my view is probably the most important point, which is the flexibility. So we're going to delve now into the tax planning and structuring, but flexibility is important. So one of the big negatives of a life retirement annuity is that it's not very flexible. What I mean with regards to flexibility is I want the investor or the client to be able to, at the drop of a hat, be able to pause, increase, reduce, or even cancel the monthly contribution towards their retirement annuity. So the flexibility is very important because we all know that life happens and there's a lot of things that happen, specifically from a tax point of view. So I want to have that flexibility built in, hence why the recommendation is to use a unit trust retirement annuity that does provide this flexibility because of the way that the fees are structured. So those are the kind of the 4 points that you just need to kind of keep in mind. Unit trust, retirement annuity, make sure that the fees are not excessive. Make sure that you know who's the administrator versus the portfolios and who the portfolio managers are and how much they charge. And make sure that you have that peace of mind that there's sufficient flexibility with regards to the contributions that you want to allocate towards the scheme. Okay. With that now all and done, I'm going to show you a practical example of a specific client in terms of how we utilize the retirement annuity to save some tax, and then we're going to go down that rabbit hole a bit. So let me share this screen quickly with you. So here you can see this is what we call a ITA 34. So this is the document that SARS issues when you submit your annual tax return, right? I've just taken out the important parts or the personal parts of the client, and I'm now going to zoom down to the lower part and just quickly highlight all the important aspects thereof. So you can see this client had local interest income that they earned. They had some foreign interest that they earned. They had some foreign dividends that they earned. They got some distribution from a REIT or real estate investment trust. They made some capital gain as well. So you can see purely just by looking at this, obviously this client has got some investments that generated some passive income, and all of those passive income is obviously taxable, hence why the information is on the return. You can also see this is the client's primary trade other than letting a property. This is how the client generated his or her income. And if we now scroll down to the bottom, you can see this amount here is effectively the income. So according to SARS, we rope in all your income, so the income that you earn from your primary trade, all your investment income, capital gains, etc., and that amount, let's call it close to 570,000 Rand, is the amount of tax that they're going to calculate on that amount as things stand. However, very importantly, you are allowed some deductions. And the most important one is this one, your contribution towards a retirement fund. And you can see now, it doesn't say pension or provident fund or retirement, it just says retirement fund contributions. But below that, I'm actually going to zoom in a bit. You can see that there are retirement fund contributions, which is the pension and provident fund contributions. The client had 41,000 Rand. You can see on that side. Very importantly, just look at this amount. Amount brought, the BF stands for brought forward from a previous year, was 94,000. So what you can see, I'm just going to take that one out. There's this 41,000 Rand that he contributed. Sorry, it wasn't a pension one, it was a retirement annuity. Then there's certain formulas that we need to apply. So you can see, you can just read the formula, but it's 27.5% of a greater of amount, or 350,000, which is the capped amount that you can contribute towards a retirement fund. All that I wanted to show you is that you can see that this 41 plus the 94 added up to the total 135, and this was a deduction that we got off the tax return, which is the important part. So remember, if you now take that 570 less the 135, we get the amount that the client actually needs to pay tax on, and that amount is only 430,000. And now you can see in terms of the benefits of utilizing a retirement annuity. So the tax amount that would have been due was 570. Because he made a contribution of 130, tax is now only liable on the 430. But this is the important part. That 130,000 Rand, remember that money is not gone. He didn't spend the money or gave it to SARS. That money is still his money that was just moved from his bank account into a retirement fund. Then is continuing to grow. Very importantly, remember all the tax, there is zero tax within a retirement fund. So you're transferring what we call kind of discretionary money in your bank into a retirement fund, which is growing. There's zero tax within that fund until a future date that you decide to retire. That is a massive, massive benefit that you have. And I'm just going to quickly show you the following screen in terms of the calculation, the tax saving. So I just want to go quickly to this screen. So let's first show you this calculation. So this calculation, remember the client initially had 560,000. So based on this calculator that we use, the tax that would have been due was 236,000 Rand on that amount. So if you earn 560, you would have to pay 236,000. However, it was the other way around. 690 was what the client earned without the tax, the contribution, the 560. So you can see the tax saving, 236 versus 294. So in theory, there was already a 60,000 Rand saving for this client by making the contribution towards a retirement annuity fund. So the important aspect that we try and kind of motivate clients is that, remember, you might not have access to the money, because remember, when you move money into a retirement annuity fund, you cannot access the money until you are age 55. So that's the quid pro quo. So SARS will give you the tax deduction, but to incentivize you to save for long term, you're not allowed to take the money before age 55. So you have to kind of commit the money towards a long-term saving. But very importantly, so again, let's just bring it all together now. Remember, you get the tax saving on day one. As per that calculation that I just showed you, that client saved effectively 60,000 Rand in tax because of the 130,000 Rand contribution that they made. So that's the saving you get on day one. You get that 60,000 Rand back in your money in your pocket. So you contributed 130, you get 60 there from that 130 back. So you actually only contributed 70,000 Rand. However, that 60,000 Rand that you did contribute towards the fund is now growing. And again, if you follow those four structures and use the right retirement annuity, it will grow at let's say a minimum of a 9% net of fees, compounded year over year until you are age 55 or even later. Remember, there's zero tax within that growth of that fund. And this is the other important part that I wanted to show you in terms of another big benefit that a lot of people don't utilize. So let's just, I want to highlight this part in terms of that. Amounts that are not claimed, so remember, this is your retirement annuity contributions, as a deduction in any year of assessment as a result of the limitations are compounded. When the individual retires, for example, the compounded or excess contributions that did not previously rank for deduction of which were not exempted can be used to reduce the gross lump sum figure on which the tax will be calculated. So, in a nutshell, remember that, let's fast forward now. So you're now 40 years old, you make your contribution, the 60,000 Rand goes into the fund, it grows. At a future date and time, after the age of 55, you will obviously want to retire. So most people know it's that 1/3, 2/3 rules, which means that if you've got 3 million Rand in your retirement fund at retirement age, you can take a maximum of 1/3 or a million as a lump sum. But remember that lump sum is taxed based on this tax table that SARS has at the moment. So you can see the first 500,000 is tax-free. The next 200,000 is at 18%. The next 350 is at 36%, and everything above 1,050,000 is taxed at 36%. So in our example again, I can actually jump to this calculator quickly to make it easier for us. So retirement lump sum calculator. Let's say I've got 3 million and I want to withdraw that 1 million. You can see 793,000 is the amount that I'll get back after tax. However, and this is the important part that we want to kind of stress. Let's say that again, you made excess contributions over and above the 350,000. So let's I think it's important that I share that screen again because we need to stress that point very importantly. So if you look at this calculation, it clearly stipulates there that the deduction is limited to the lesser of 350 or 27% of the taxable income, which means that SARS will calculate, and they actually give you the value there. There is the value 568,000. Is the 27.5% of that amount, or 350, whichever of the two amounts is the lesser thereof. But even, let's take this example now. Even if this client contributed 1 million Rand towards his retirement fund, that excess contribution does not disappear. All that it means, it will calculate. So either if the client is not retired, you can see it will be this amount brought forward from a previous tax year, this 94,000. That 94,000, let's just, that 94,000. And if it's in the year that the client does retire, that excess contribution can actually be used to offset the lump sum tax amount that the client would have paid. So again, just to bring it practically all together, let's slowly explain what would have happened. So for that specific client, in his last year of retirement, if he contributed 1 million Rand towards his retirement annuity, we know that there's a limitation. Let's say, as an example, he could have only claimed a portion of that tax liability, the tax benefit. The excess contributions would have been carried forward, right? We know that. And even if those excess contributions were not used, at retirement, he's got 3 million in his kitty. He wants to withdraw his 1/3. We know that SARS gives the first 500,000 is a tax-free amount, but his additional excess contribution that hasn't qualified yet for tax deduction can now be used to offset that. So if we assume the other excess contributions that weren't used was also 500,000, it would be 500 plus 500 would have been 1 million, and he would have been able to withdraw his 1 million tax-free. Now, it's important to understand that the idea, and this is where the tax planning element comes in. If you have a large tax liability that's looming, you could utilize a retirement annuity to effectively defer that tax liability and hopefully also reduce that dramatically. So let's say you earn a lot of money and now you owe SARS a lot of money. Instead of paying that tax and being poorer on day one, you can utilize and transfer a large amount of money into a retirement annuity. You'll get immediately a tax saving on day one. There'll be excess contributions for the future tax years. That excess contribution and the large amount that you allocated towards the retirement annuity fund will continue to grow. There'll be zero tax on that. And at a future date in time, if there's still excess contributions that didn't claim as a tax deduction, you can withdraw a larger lump sum amount, a larger tax-free lump sum amount. Remember, the 1/3, 2/3 rule still applies. But you could just imagine if you're in your 30s and you allocate a large amount towards your retirement annuity, obviously your fund value at retirement will be a massive amount. So those are clever tricks in terms of how to restructure your portfolio to get the massive amount of tax, not just on day one, but in future tax years, and ultimately all the way through until your retirement age. So I know a lot of these things might have been a bit complicated and a bit technical in nature. So if you're unsure about anything, just drop a comment below. If you found value from this episode, feel free to share this on to family and friends. As always, all our socials, contact details and everything are below in the comments. So please feel free to reach out to either myself or my team so that we can have a one-on-one discussion and highlight and explain to you exactly how we could utilize this strategy in your personal situation to save you massive amounts of tax. And that's it. Until next week, thank you very much. Goodbye.